It's Income Investing Week here at the Morningstar UK office. So today we're taking a little look at some income investing tips for beginners. I'm Ollie Smith, and joining me on this walkthrough of the basics of income investing is Ellie Clapton, who is product specialist on the Morningstar rated 91 Diversified Income Fund. Ellie, thank you so much for being with us this morning. What is income investing?
Income investing is essentially selecting investments designed to deliver a steady stream of income over a certain period. And there are a number of ways to generate income. It can be in the form of dividends, bond yields, and interest payments. And then investors can either choose to take the income distributions as cash, or they can then reinvest those distributions. And reinvesting income can be a major factor in long-term returns because it's the cheapest and easiest way an investor can increase their holdings over time. And that is known as the power of compounding.
So to achieve kind of the best returns, if you imagine that I'm a DIY investor and I'm doing this for the first time, I might be very attracted by some of the highest yields. Is it always best to go for, the highest yielding assets?
Quick answer, we would say no. And that's because simply looking for the highest yield isn't enough. And that's because an inflated yield is often a risk indicator because it could suggest that investors want their money back as quickly as possible, or that the yield isn't resilient and therefore it's likely to be cut. So therefore we think it's important to not only focus on the yield and the level of that yield, but to also focus on the dependability of the cash flows that are required to deliver that yield. And we find that the best mix of returns, particularly when viewed alongside measures of risk, sit within those yields that are higher than average, but not necessarily the highest.
Okay, let's just do a little bit of history then. So how has income investing changed perhaps over time?
Well, I guess historically, bonds have been regarded as the good way to earn income because historically they've been considered as relatively safe investments. But investors have been struggling to find yield from traditional sources since the global financial crisis because we've had a decade of low interest rates as well as ever looser monetary policy. And these issues have been exacerbated by COVID, and now investors have very limited options with respect to income from cash and also developed market government bonds. And even many corporate bonds also offer very little by way of income now. So we think, looking forward, in order to navigate this more challenging environment, and because it's changed from what it was in the past, we think it's important to cast the net wide and to take advantage of a broad multi-asset opportunity set. So, for example, we see some really compelling income opportunities in high dividend yielding equities whose dividends are underpinned by strong cash flows. And we think as the world recovers and returns to normal, those cash flows can rise, which in turn can fund distributions to investors. And actually, even fixed income and bonds, they're not barren. We still see opportunities there, but it's crucial to be selective and to focus on those yields that are, as I say, backed by resilient cash flows and can compensate for the risks that investors are taking. So maybe just to summarise, looking forward, investing across a range of asset classes is a good way of earning a steady income over the long term, whilst also preserving capital in more volatile periods.
Sure. And then final question I have for you. I mean, the dream surely is to live off, your income from investments, not to have to work. Is that a good idea?
Well, I think it's possible, and I think you need to think about the fact that there are essentially two ways that investors could live off investments. So the first way is an investor could take a natural yield approach, and that would essentially mean taking income from their investments. So that's either the interest of bonds or the dividends from equities, and then that natural income will be used to fund their lifestyle. But it's worth noting that income would vary depending on the investments. The second approach would require starting off by determining the level of income that you would need to fund your living standards, and then periodically selling the number of investments needed to generate that income. Now, there are disadvantages and advantages to both approaches, and ultimately the right option will come down to the individual investor. But irrespective of that, we think that it is still possible to source an attractive and resilient natural yield of around 4% from a multi-asset set of investments. And, investors could either take that income, take that natural yield, or as we've discussed, reinvest that yield, and then down the line, periodically sell that income, which will either be higher or lower than the natural yield, in order to fund their living.
Awesome. Okay, so I just thought that was an absolutely fantastic explanation, and I think, perfectly pitched in terms of the sort of person that might want to learn a little bit more about income investing. If you are one of those people, you can check out our income investing coverage throughout this week on morningstar.co.uk. In the meantime, however, I've been Ollie Smith, UK editor for Morningstar.